Amid U.S.-China trade tensions threaten the global economy. The trade volume between the U.S. and China reached about $585 billion last year. While the U.S. imported $440 billion worth of goods from China, China imported only $145 billion worth of goods from the U.S. This imbalance had begun to create fragility and discomfort in trade relations between the two economies. According to the International Monetary Fund, the U.S. and China together account for around 43% of the global economy. A full-scale trade war between the two countries could therefore have a negative impact not only on bilateral relations, but also on global growth. A trade war between the two countries, tariffs are big enough to affect the whole world: stock markets, funds, economies, and product costs. China is the world's largest producer. The country produces far more goods than the domestic market can consume, and with a surplus of about $1 trillion, it has a huge export power across the world. In other words, these guys can direct the world market, they can turn markets upside down, and if they want, they can turn the flow of money to themselves by supplying cheap goods and slowing down the markets. Subsidies and cheap loans to state-backed firms help China keep production costs low. But if these products cannot enter the U.S. market, they risk being diverted to other countries. In the short term, this may mean cheaper products for consumers. But in the longer term, such disproportionate competition is likely to put pressure on wages, employment, and local production in other countries. Many economists believe that this escalating trade tension between the U.S. and China will be felt on a global scale, with a spillover effect, and the consequences could be quite negative. In an interview with a news agency, Alfredo Montufar Helu, senior advisor at the China Center of the U.S.-based think tank, the Conference Board, stressed that China should not be expected to back down. Such a step not only makes China look weak, but also gives the U.S. an advantage to make more demands. If China backs down, it means it is caving in, and its position and power in the world will be destroyed in people's minds. We are now in a stalemate that will cause long-term economic damage. The additional tariffs imposed under U.S. President Donald Trump have taken global markets by storm and upset markets. According to many experts, this raises the possibility of a global recession. Although the decline in stock markets does not directly imply an economic crisis, the recent deep losses indicate that the profitability prospects of large companies have been severely shaken. Rising tariffs are causing production costs to rise, profit rates to fall, and insecurity in the markets. What do you think about this? Do you feel insecure or fearful? We should discuss this in the comments. In the aftermath of these developments, losses of more than 10% in some banking stocks and significant losses in large corporations raised concerns about the soundness of the financial system. At the same time, copper and oil prices, which are important indicators of the health of the global economy, fell by more than 15%. Major companies such as Apple started to stockpile in the U.S. after the increase in tariffs. Modern history has witnessed only a few recessions on a global scale: the Great Depression of the 1930s, the COVID-19 pandemic, and other rare recessions. While today's Trump-era tariffs have not had a similar impact, experts say the risk of recession in the U.S., the U.K., and the European Union has increased. Trump's subsequent 125% tariffs on China, and his statements that the tariffs imposed on other countries would remain at 10%, and that this period would be limited to 90 days, had a bullish effect on the stock markets.